Hi, and welcome to another Real Talk Live with the Mulholland Ross Group. I'm Aura Ross, and today we have Rakhee Dhingra with Mortgage Savvy. And we're going to jump into all the changes that are going on. There's been some great change, well, not great. There's been some changes to mortgage requirements and stuff like that. But first, I wanted to take a minute because we received a few interesting graphs, and you know I love stats and graphs about the market. So with that, we'll just jump into that for just a minute. And there we go. The team was enjoying this just a few minutes ago, so I will we'll go over this today. So this is comparing just the last few weeks. You can see the graph just goes back to February of 2020. And we're just looking at this year compared to this exact time last year. And this center line here being zero change from last year. So if we were to look at that, you can see that, I'm just going to move this over in case you guys can't see it. We've also got it done by area. So you can see if we were taking a look at Durham just last week, there's been zero change in sold prices year over year. If we were to like just micro look at that. And then Toronto, you can see. Are we happy? Prices are up. I know we're hearing a lot of people talk about a horrible market, but the reality is these are all home types, by the way, across the city of Toronto. And as always, we can break this down by neighborhood for everyone. But look at that. Look what Halton did over last year. Now, again, this is just by week. And I want to thank the company Four Walls because they put this together for us. And they made a decision a couple months ago that looking at this stuff monthly isn't fast enough. Kind of like us. We jumped on this weekly conversation because so much is happening in a month. It's too much. We have to do it monthly and sometimes daily, right? So there you go. What's interesting is here are our number of solds. So again, this is what would have been last year. And so you can see there's Toronto. So our number of sales are down, right? But we're not fretting because we saw those prices, right? And a lot of people have thought that because our listing inventory is low, number of listings have remained fairly low. Let's just take a quick look at that. One sec. If you take a look at how those listings fell way below last year's listings. So those buyers that were out there that wanted to buy didn't have much to choose from. Those prices held on, right? And just again, looking in the last 2 weeks of May, what we're starting to see is that inventory pickup. And I think all of us I know all of us on the team, and I'm sure Rakhee, you can probably agree that in the last few weeks, you've felt it get busier. And so there it is. So now what we need to see are, we need to see the buyers show up because the listings, we're seeing more listings now coming to market than we saw last year. Sales are still down though. So what we really want to see in the next 2 weeks are those buyers show up, and then that will probably give us a pretty solid, steady market through the next few weeks. What do you think?
Yeah.
Lauren and Davis, I know you've been out showing homes. Do you have any insight from what you're seeing out there, and maybe even some of the prices you're seeing being, you know, that we're seeing in the sales?
What I've noticed, and again, it sort of talks about what we were looking at last week, the home price index. I was breaking down some townhouses in Vaughan for a couple I'm working with, and the main point I wanted to show them was that the list to sale price are almost at 100%. So yeah. I just wanted to let them know going into it, I always like to warn people, don't go in thinking that, you know, your budget is 8, let's look at 850 or 900, because we're just not seeing that type of negotiation going on. So I think serious sellers are pricing properly, and then the serious buyers are coming along and paying that price. So that's definitely one thing I'm noticing. List to sale.
I think you nailed it too, because one of the other stats we were looking at is of the homes that are selling, the list to sell ratio in the last 4 weeks has been between 100 and 110%. So again, we got to be careful. It doesn't mean that if you're out there, you want to sell your house, it's 2017 again, pick a price and the buyers are going to pay you more anyway. It's if you nail the price. So if your realtor is able to really articulate the value and you nail that price, chances are someone's going to come in the next 2 to 3 weeks and make an offer of full price or more. The properties that are sitting overpriced, the sellers that are saying, well, I'll negotiate down or whatever, you know, I'll negotiate, just bring me an offer. Those homes actually aren't really selling. So almost feels like the buyers don't want to play games either, you know, you price it right, I'll negotiate well, or not interested. I don't know.
Yeah, no, definitely. I can, I would say the same thing. Definitely just going through these homes. I've been looking at homes north of Steeles lately in the Vaughan area, and there's definitely an increase in listings, and the average days on market is definitely a little longer than south of Steeles in certain neighborhoods. But like you said, the list to sell ratio is pretty spot on, and the homes that are priced right are actually selling fairly quickly. It's the other ones that you're seeing them sit a little longer. Yeah.
Right. And Jordan, I know you've been looking in the city. Have you noticed anything in the downtown condo market? Are you seeing anything?
Yeah, I mean, definitely we're seeing, you know, properties that show well and are priced right are, like you said, getting full ask or more. They're selling, you know, very quickly, sometimes a week or less. We're seeing, you know, sellers also potentially pricing under and getting multiple offers. So we are still seeing multiple offers in some areas in the city. And especially in some of the downtown pockets, we're actually starting to see them come back even more. More and more properties holding offers because there was a shortage of inventory. Now we're starting to see more inventory come out. So we'll kind of see how that plays out these next few weeks. But yeah, we're seeing definitely, you know, opportunity in terms of options to choose from and serious sellers. So, you know, good market to sell and a good market for buyers to be able to capitalize on, you know, some of the opportunities out there.
Good. Okay, well, Rakhee, we're all anxious to hear about all the changes going on, and any advice you could be giving us as realtors and anything you can give our clients that are on, and we'll try to feed you any questions that come through.
For sure. So feel free to populate your questions in the chat, and I'll be sure to address those questions. I'm a mortgage agent. I'm also the broker of record for Mortgage Savvy, and I've prepared a quick presentation here. Just give me a moment. You'll have to just confirm that you can see my screen.
Yeah.
Okay, perfect. So just here to provide lots of changes since the onset of COVID in the mortgage industry with respect to rates as well as lending guidelines and policies. The one question I feel that keeps coming up with clients that are reaching out is now the right time to buy? And my response always is that our role has really shifted. I've become a mortgage coach. So it's really about connecting with our clients and really understanding their individual set of circumstances. The one thing I will personally see in terms of what we're seeing at Mortgage Savvy, we're seeing first-time home buyers and buyers that were, you know, shopping for homes in January and February with that immense amount of competition, actually be able to secure homes at list price. So I'm not seeing them necessarily secure it under, but we're definitely not seeing as many properties kind of going for those sort of unrealistic values. I think list price these days is in line with what clients are being able to secure these properties for. So I feel like for a number of my personal clients and what I'm seeing in the market is that this has been it's been a win for those that have job security, that have that stability of continuance of income. We're also seeing mortgage rates at historical lows. So those that were paying attention to the Financial Post article on June 8th indicated that we have 5-year fixed rates at 1.99%.
Wow.
14 years in the business, I don't think I've seen that prior, not on a 5-year fix. So with rates being at historical lows, what I'm encouraging clients that may be contemplating a purchase, still maybe unsure if there's sort of next steps, this is an excellent time to just get educated, go through the process of securing a pre-approval. And given the current set of circumstances that we've gone through, I'm also highly encouraging a conversation on affordability and really ensuring that you're comfortable taking on these financial sort of and these monthly obligations. So we're really focusing our attention on sitting with clients, ensuring that we are understanding their income, understanding their obligations on a monthly basis, and helping them just get clarity on what they could potentially afford should they decide that they're ready to kind of take that next step. What we're also educating clients on is that given that rates are at historical lows, there's no harm in holding on to a pre-approval. These pre-approvals lock you in on a rate for 120 days, and then take your time to continue to observe, as inventory continues to surface on market, and find the right property for your needs.
So Rakhee, if I can just ask a quick question, basically just based on what you said. So in theory, a good first step for anyone even considering doing a purchase, when you said this conversation on affordability and on getting a pre-approval, it really is just that. It's starting the conversation, talking about their needs and their wants, and kind of going over some numbers so they get clarity on their numbers, essentially, right?
Absolutely. We want them happy well after they've moved into the property. So we want them comfortable from an affordability standpoint. So again, the initial step is really just to educate and provide information so that so as a potential buyer, you have clarity on what you can afford and what you qualify for. And it's balancing the two, which I think is key in supporting, a purchase. On Thursday, June 4th, we had CMHC, which is one of 3 Canadian mortgage insurers, announce that they will be making some changes to the qualification guidelines effective July 1st. So we did see a flurry of activity this weekend. A number of first-time home buyers did, kind of rush out concerned with these potential changes. I think that purchasing a home is such a sizable financial decision that I think it does require proper preparation. And what we did find effective Monday is that not all 3 insurers will be making these changes. So it's only specific to CMHC. Canada Guarantee and Genworth will be maintaining the existing guidelines, so there is no change. So we have options for our clients. I did want to take a moment, however, to kind of review some of the changes that CMHC will be implementing effective July 1st. And the first change is that they will be reducing their overall sort of ratio requirements. So whenever a mortgage lender or a bank is extending you a mortgage, they're doing so on the basis of your household income to the carrying cost of the property, as well as your household income to your total debts that you carry, whether there be a car loan or a student loan. They're incorporating your total sort of debt exposure. And effective July 1st, what they're doing is they're narrowing those ratio requirements. To give you an example, if you're a household with $120,000 in income, effective today, that would mean you'd be able to qualify for a mortgage around $565. This is assuming a 5% down payment plus the insurance premium. But effective July 1st, that will then reduce to about $502. So we're seeing about a 12% sort of decline. Now, this is specific to CMHC only, but it's important to be educated that we have seen this change with this one insurer. They're also requiring that at least one borrower on an insured mortgage have a minimum beacon or credit score of 680. And the third change is they're wanting to ensure that any down payment funds are actually from savings. They can still include a gift from family. And if the family has a home equity line of credit or a credit source, they can still draw funds from that facility. So we've gained some additional clarity there. Now, for those that are wondering what's an insured purchase, that's when you're looking to purchase a property with the intention of occupying it either as your primary residence or a second home. You can do so with less than 20% as a down payment. So an insured mortgage would apply to anybody looking to make a purchase under $1 million with the intention of occupying the property as their primary residence or a second home with a down payment of less than 20%.
So Rakhee, a question for you about that, especially with the credit score. If someone does have a credit score under 680, Do you recommend that they still reach out and at least start the conversation and find out what things they could do?
Absolutely. Not everybody has perfect credit, and I often say there's not a lot of logic to the credit reporting system. So it's never too early to engage. Some tips and tricks are ensuring that you're making your payments on time. And one great sort of tip that I share with clients is diarize your due dates and ensure that you're making your payments 5 business days before to ensure that there's no potential delays. The other sort of often what I will suggest is that clients have at least 2 sources of credit that they're actively using. If you have credit and you're not using, it's not reporting. And if you're overusing it, you can potentially see a decline in your credit score. The magic number is 65% utilization. So what that means is ideally you need to have credit, you should be using the credit, but you can't be overusing the credit. So let's say you have a limit of approximately $5,000 on your credit card. We would suggest that you not exceed that $3,250 sort of balance at any given point in time. So you want to just be mindful of your overall utilization, and it's never too early to connect. If you are looking to make a future purchase, it's great to connect. And with CMHC's sort of standard of having at least 1 applicant with a credit score of 680, what's important to note is that the other 2 insurers as well, and banks and lenders in general, if you have a credit of 680 or above, you're going to be able to secure the largest mortgage because they'll give you extended ratios, and you'll be able to secure the lowest interest rate. So any score of 680 or above is going to give you access to these sort of historically low interest rates when you purchase a property.
And I see we have one of our phone-in callers has a question saying, what would be a non-traditional form of down payment?
A non-traditional form of down payment would be a line of credit that you may, an unsecured line of credit that you may have available to you, that you may, you know, if you're looking to make a first-time purchase, there are a number of lenders that would have allowed you to tap into that. We would still have to factor the payment requirements on that line of credit when qualifying you for a mortgage, but you were in the past able to use any existing credit facilities to pull funds to meet that minimum down payment requirement. And so now effective with CMHC, specifically effective July 1st, they do not want to see the down payment being sourced from any sort of credit facility. What they're looking to do is they want to ensure that you're not overextending yourself when taking on a purchase.
Right.
Hoping
that makes sense.
So credit score is something to be mindful of. I'm also going to kind of just walk through a few sort of options in terms of down payment that fit the insured guidelines, and then I'll walk you through the minimum down payment requirements, what an insured purchase looks like, and the next steps to securing a pre-approval.
Sorry, Rakhee, just before you dive into that, I just see that we have a question here.
Absolutely.
So the question is from Brenda, saying that her husband has a pre-approval rate. They saw basically a 2.5% rate from RBC, and they're just wondering basically why, or which banks or which lenders you're seeing that 1.99% in those systems.
So I would have to connect directly, and the reason for that is it's very specific to product. So, you know, post 2017 and 18, what we've seen is that it's specific. Is it an insured purchase? Is it uninsured? So the 1.99 is effectively offered by a few lenders, and I'm happy to connect directly and kind of give you an overview of that product. It is for an insured mortgage where it's either a purchase or a refinance of a property under the $1 million mark with the minimal down payment. So there are a few lenders offering that rate special currently.
Okay. So it has to meet that specific criteria in the purchase.
Correct. So to really provide an accurate overview of what the market rates are. So for example, insured lowest market rate right now, 1.99. Uninsured, that's sitting closer to 2.29. So we need to kind of gain some clarity. And on a 30-year amortization, we're sitting closer to 2.34. So again, it's very specific to the product you're looking to secure.
Perfect.
And so just to clarify that, I just want to make sure for anyone that's on the call that may not understand, when you say product, you mean the mortgage itself? Or the,
Correct.
Right?
Correct.
Okay.
So I am referencing 5-year terms, and I'm still referring to fixed rate 5-year term rates. However, there is now a distinction between insured and uninsured, and amortization of 25 versus 30, which will yield a different rate.
And so I think kind of from what I heard you saying, the moral of the story is even though you see the big flashy news on TV or in the newspaper that says 1.99, like, you know, it's about having a call and really understanding each
Yeah.
individual person's needs, requirements, and qualifications, right? Because although you might see that, it's not necessarily available.
Absolutely. And it's also the fine print. And this is where there's that distinction between working with the bank versus broker. I feel that, again, the last 3 months have shown us that life is uncertain. And it's important to be prepared for an exit strategy and options, whether it's, you know, you're looking to tap into additional equity or you're in a position where you need to sell. It's so important that you're paying attention, not just to rate, but what are your prepayment penalties? What are your prepayment sort of privileges within a contract? What would happen if you needed to tap into some additional equity or needing to sell? So these are conversations that we like to have on the onset. We want to understand. I know life is somewhat unpredictable, but it's also important to kind of prepare for, you know, the unexpected.
I really appreciate that, Rakhee, because a lot of times our clients are walking into the banks and the banks don't ask all the questions. You know, we're it's never a one size fits all. We always say that. And that's why a lot of times when we meet with people as well, and we're sitting there asking a lot of questions, it's because there is no one answer. And we really want to get the big picture so we know exactly how best to help you. So I really appreciate the time you take with us and our clients drilling into this for us. Okay.
And I see, I think Brenda was looking for some clarity. I think she's going to try and unmute herself here. Brenda, are you there? No, maybe not. In the meantime, just had something in my head and it went off. If I remember, I'll come back to it. Sorry.
I'm always struggling with the question, why are the insured mortgage rates so much lower than the uninsured? So here I've saved up 40%. You know, I'm going in with all my hard-earned sweat equity, and the bank's going to actually charge me more insurance than if I didn't have all that money. Can you explain that one?
Absolutely. So post 2017-18, we saw the introduction of the stress test, which also started to distinguish the insured versus uninsured mortgage rates. And really, it comes down to competition in the market. So with our insured lenders, they're government-backed mortgages. And when we're referring to insured mortgages, we're not insuring or necessarily protecting the homeowner. The insurance is also to protect the lender from default. So it's important to note we have a larger pool of lenders that are willing to lend in the insured mortgage realm. We have a number of monoline lenders that can be very, very competitive. The funds that they extend for mortgages are their investors, like investments into these mortgages, into these mortgage funds. And the insured mortgage sort of, you know, market is quite lucrative, and there's tremendous amount of competition. Added sort of competition, additional lenders drive rates down. You'll find that when you're looking to make a purchase of 20% with a 20% or more down payment, you're generally going to find that the banks and the credit unions are going to be your most competitive rate offering with the uninsured rates, because you have less competition. Rates are sitting slightly higher. However, given the last 10 days, I will say that with the rates having fallen as significantly as they have, the spread between the insured and uninsured rates has really kind of narrowed. That gap isn't what it was reflective to be even 6 months ago. It's really narrowed. It's about 15 to 20 basis points at present. So it's really minimal.
Hi, can you hear me?
Yes, I can.
Hi, yes, this is Brenda. Yes, I asked that question is because like my husband we bought a new home in Oakville.
Okay.
And we are putting 65% down. And we only want to borrow 1/3. And my husband went to a couple of banks, the big banks, the RBC and CIBC. And they say that the best rate at that time, which is a few months ago, was 2.49. And they say that, yes, my husband is a good client because we don't have any debt. We pay off our condo, we pay off our house, our car. So we don't have credit card bill debt. So we actually are clean. But the RBC specialist say that the best rate he can give us is 2.49. I was wondering, is it this 1.99? Is it a very recent rate reductions?
Yeah, so in the last 10 days, we've seen a tremendous, a day-to-day decline. My mornings start with renewing approvals. We're busy. So the difference between, again, broker versus bank, a bank will lock you in on a rate, a broker will continue to shop that rate up until 72 hours before your closing. We're in a declining rate environment. So these changes are relatively recent, I'd say within the last 10 days, and on the onset of Monday. Since Monday, we've seen 3 rate declines, and these are not necessarily from the Bank of Canada. This is just our big 6 competing for market share. We're seeing the rates decline. If I may ask, if you're open to sharing, what was the purchase price of the property?
The purchase price is about 1.7 mil.
Okay, so this is considered uninsured. So our lowest uninsured rate at the moment for, again, I won't disclose lender, but I'm happy to connect with you, would be, is it a 25 or a 30-year amortization?
We are thinking of looking at 25 years.
So if you're looking at 25 years, the lowest would be 2.29.
Okay.
And a $2,500 cashback.
$2,500
cashback.
Oh, cashback. Okay.
And RBC is offering the cashback as well currently.
RBC is offering, because my husband haven't get in touch with RBC again because our closing will not happen until September, end of September.
So we can still lock you in on a rate. We can still lock you in on a rate. So if your closing is, as long as it's within a 120-day period, I can still secure you the rate. It just may be helpful to connect one-on-one, and I can take down the specifics and give you an overview of what we can secure.
Okay, I will have a discuss with my husband. Is that okay that we talk afterwards?
Absolutely, for sure.
Okay, yes. Okay, thank you very much.
Oh, my pleasure.
And we'll post Rakhee's contact info in the chat box. So if you need to reach out to Rakhee and her team, of course, please feel free, because they're amazing. Rakhee, what I think I heard you say as well recently was that there is a difference between just going straight to your bank and dealing with the bank directly versus dealing with a mortgage broker like yourself, and that you do also have access to bank products as well. Is that correct?
For sure. We absolutely do. We do get access to floor rates as well, meaning I'm aware of what the branch is offering, and I ensure that there are some lenders that we don't have access to through the broker channel, but we stay informed. We ensure that we're aware, and we're always going to provide clients with advice in their best interest. So we're more than happy to provide any sort of, like, RBC will only do branch and sort of independent RBC agent business, but I'm aware of where their rates sit, and I'm aware of the additional sort of incentives that they can offer their clients. So, if you're looking to stay with your existing lender to avoid any penalties or fees, I'm more than happy to provide support. I consider myself an extension of the team. We're here to support and educate and try to save you where we can. I think every dollar counts today, and we're here to provide that support.
That's great. Thanks.
Thanks.
Absolutely. So in terms of sources of down payment and minimum down payment requirements, so I just wanted to kind of just highlight that when looking to make a purchase of $500,000 or less, minimum down payment is 5%. Anywhere between 500 and right just below that $1 million mark, it's 5% of the first 500,000 and 10% of anything above. And I'll walk through a scenario on our next slide. And anything, once we hit that $1 million mark, we are restricted to working with a minimum down payment of 20%. So on a $500,000 purchase, that would reflect a $25,000 down payment. For $750,000, it would be 5% of the first 500 for $25,000, 10% of anything above for an additional $25,000 for a total down payment there of $50,000. And the moment we hit that $1 million mark, it's 20%, which would be the $200,000. So I did want to go through a scenario of breaking down what an insured purchase looks like. When you are securing an insured purchase, there is a cost. That cost is referred to as a insurance premium. So assuming, you know, there's a purchase of a property at the 500,000 price point, that would require a down payment of 25,000. The mortgage being requested would be 475, and the premium and the insurer charges is on a sliding scale and declines as you increase your down payment, but it's a percentage of the mortgage amount being requested. In this specific case, it's 4% of the 475,000 mortgage being requested, and that insurance premium is then reflective of 19,000. That gets added to the overall mortgage. So it's important to note that this is not an out-of-pocket expense. It gets added to the mortgage. And where I have a conversation with a client where they indicate, you know, should we be saving? Should we be waiting and saving, or should we be acting now? I will often redirect them to their realtor to really have a conversation on where would they like to be, and historically at what rate have properties appreciated. And just historically, what we have found is that in Toronto and the GTA, conservatively, properties have appreciated at a rate of 5%. So if you look at that 4% cost, you're making it up in the first year. So sometimes it does make sense to take that step now, but I will always revert to the numbers. You know, this being in the mortgage field and working with clients on the numbers, we let the numbers speak for themselves, and we'll educate you and support you with the information so that you can make the right decision for yourself. Now, I wanted to kind of also reference, so a rate of 2.19, which is kind of a very sort of not aggressive, but it's our standard sort of market rate for an insured purchase today. That monthly mortgage payment is going to reflect $2,139.84. Oftentimes, as consumers and as home buyers, we look at that as an expense, and we kind of will sometimes equate that to what we may be paying in rent. What we forget is that payment is actually divided into two components. There is a principal component, and then there's the interest component. What's interesting is with rates being as low as they are, that principal repayment today is reflecting $1,238.39. That means of your payment, that $1,238.39 is what you are actually putting towards principal. And I like to use the analogy, it's like taking money from one pocket and just putting it into another. It's a form of forced savings.
And Rakhee, that's more than 50% of your payment every month.
Correct.
And that's on payment one.
Yeah.
So I forget, I remember years ago, there is a number of which it goes up and then more of your payment is interest.
Correct. So as you continue to pay down your mortgage, on the break-even point, I'd have to calculate it for you. I think it's just after that 7-year mark, right? But it does decline. But right on the onset, based on where mortgage rates are sitting at the moment, right out of the gate, you're putting more towards principal.
When I first got into real estate, I think when we'd show people that first payment and show that $67 would go towards their principal, you know, and 2,000 is going to interest.
It's
very interesting.
And I will also kind of just draw from a recent experience that I had. I had a client that had come to me a year and a half ago with a limited budget. She wanted to buy a condo downtown Toronto in 2008 and was hoping for a budget around $500,000. And in 2008, that was doable. However, when we ran her numbers, we were looking at a qualification of $350,000. And her response immediately was, well, I can't afford anything. I asked her to reconnect with her realtor and just educate herself on what the options were. She did end up purchasing a property. The property was actually purchased in Scarborough at the time. It was a condo property. She purchased it for $350,000. 1 year and 8 months later, she was able to sell that property. Between principal repayment and year-over-year appreciation, she was able to walk away with a net of $105,000 and now is able to buy that property. So sometimes it's building a strategy. It's, you know, being aware of what that end goal is and taking the necessary steps in between to support our clients in getting there. And sometimes it is that investment decision. So looking at historical data, focusing on the numbers can kind of help clients, you know, map out that route that they need to take.
Very interesting.
I see we have a question here from Carl on refinancing, remortgaging. Basically saying he has He's into year 2 on his 5-year term in a 25-year mortgage, and he's currently at 3.2% with BMO, and he wants to know what would be involved, I guess, in refinancing or trying to get a better rate, I guess, at this point.
The conversation would be, we would need to first ensure that we have clarity on the cost of exiting that mortgage. So we would need to connect with the existing mortgage lender, BMO, to confirm the penalties for exiting that mortgage. So A, ensure that we have clarity on what those penalties are. 2 would be to look at what our lowest potential interest rate is on a potential refinance or switch of the existing mortgage, and looking at calculating the interest savings. So it's really a calculation of ensuring that we can save you enough interest to justify the cost of breaking the existing mortgage term over the remaining months. And we're happy to do that on a one-on-one basis and run those numbers. But it's also important to gain clarity on the costs associated with exiting a mortgage as well. This is why it's so important to be aware of the fine print when securing a mortgage. Sometimes we get very fixated on the rate. We also need to be aware of those penalties and what that's going to reflect. So once we have that information, we can absolutely devise a strategy. I've been working with a client that 2 months ago wanted to break the mortgage given where rates were. And at that time, the penalty outweighed the cost savings. This week, we hit that magic number. So we tracked it. And we're now in a position to be able to support that client with a potential switch because rates have fallen enough to justify taking on that switch.
Okay, great, thanks. And Carl, I hope that answers the question. So reach out to Rakhee and she'll be able to help you out. At least have a conversation.
Thanks, Jordan. So the sources of down payment, savings. So again, it's never too early to connect. I'm more than happy to help you map out a plan. I do find that the one sort of benefit of the current set of circumstances is we're spending less. So we can direct more towards, these goals of saving for a down payment. And I'm more than happy to, once we write down goals, we find that, and you have somebody holding you accountable to them, you're just going to get there that much faster. So it's never too early to devise a savings strategy. 2, gifts from family. Or if family has a line of credit that they may be willing to, make available to you to source the down payment so that you could start putting that $1,238, $29 towards savings on a monthly basis. That's a conversation to have. But now the conversation is backed with the appropriate sort of information and numbers to justify that sort of shift from renting to owning. So again, I'm here and available to provide you with the data if this is an option you'd like to pursue. 3 are RSPs. So if you do have funds in an RSP vehicle, you can use up to $35,000 tax-free. If we are finding that there's 2 individuals that are first-time home buyers that both have RSPs, you can actually collectively leverage up to $70,000 towards purchasing your first home.
Now, Rakhee, did they open that up, I was understanding, to someone who is buying a second home and potentially going through separation or divorce? They opened up the ability to use an RSP?
So there is some flexibility. So if you've been separated, there's got to be a 4-year period though where you haven't owned a property in between.
Oh my goodness. Okay, thank you for clarifying. I was not aware.
There are some loopholes, and we do find that CRA is an excellent source of just sort of validation there, but we have been able to get the exception under certain circumstances. So yes, with the first time home buyer plan for RSPs, home buyer plan, yes, there is the exception. You can be sort of redefined as a first time home buyer. What I do want to confirm though is that this does not apply to the first land transfer tax rebate. If you've ever owned property anywhere in the world, you are then exempt from that. So it is important to just draw that distinction. For your RSPs, absolutely. There's a little bit of leeway. There are conditions in which you can technically re-qualify as a first-time home buyer. But with respect to preparing for closing costs on a purchase, it's so important to note that we do need to adequately have the appropriate information. And if you've ever owned property anywhere in the world, or if you have a spouse that has owned. So it's always important to ensure that not only when we're connecting to devise the numbers, but we'll have the appropriate conversations to ensure that you're prepared for your purchase and you have the required funds, set aside or an awareness of what's needed. So securing a pre-approval, it's a very simple process. We'll connect on an introductory phone call or a video call in today's sort of times, and we'll have a conversation on budget, affordability, and we'll obtain sort of some background on your employment situation. That allows me to send you a comprehensive list of information required. And the one thing I will note is with COVID, lenders are doing a significant amount of due diligence. And prior to COVID, consumers would often view a pre-approval as securing a rate. And I find now the purposes of a pre-approval are really to mitigate all concerns with respect to your employment, continuance of income, assuring a mortgage lender that you are able to carry this mortgage. They are doing significant additional due diligence, and securing a pre-approval allows us to kind of dot our I's and cross our T's. Should you find a property, we're then in a position to be able to move very quickly for you in securing that pre-approval. So in terms of salaried employees, we'd be looking at a letter of employment or a job letter. Prior to COVID, we could get away with a pay stub and T4s. In today's environment, all lenders are making the letter of employment or job letter mandatory. So our apologies right on the onset for the inconvenience, but this has now become a mandated requirement. If you're a commissioned employee, then we're asking for T4s for the last 2 years tax years. And if you're self-employed, we're looking at your last 2 years tax returns.
Now, Rakhee, if I'm, just because I keep pulling this in and I apologize, if
Sure.
I'm now refinancing my house, similar information should be assumed?
It's the same for a purchase and same applies for a refinance or a switch.
Okay. Now, the only change is if I'm refinancing and I no longer work, I've now retired, but I still have a little bit of something on the house. Is that going to be a problem if we're, if there might be like less than 50% debt on a property still? Does that become an issue, do you think?
It does. It's important to note that lenders will only lend on the basis of income to debt service a mortgage loan. So if you are looking to switch lenders, you would need to re-qualify for that mortgage balance that's currently on your property. So if you are looking to secure a lower rate, we would need to ensure that the pension income or the retirement income is enough to justify the qualification. If not, we would recommend you stay with your existing lender so you can avoid having to re-qualify. Where we can provide support is if you are working and you know that income is going to be limited and you are forced to stay with your existing lender to avoid sort of the re-qualification process, I'm still available as a checkpoint. I can send you an email with our lowest rate offerings, and it doesn't hurt to present that to your existing mortgage lender and say, would you be willing to match this for the retention of my business and my loyalty? What we are finding is that banks are accommodating that. They are working with their clients. I will say that that's a positive thing. If you are looking to stay with your existing lender, I'm happy to provide you with just an email indicating what our rate offerings are, and you can use it as a negotiating tool in your conversation with your lender.
Okay, thank you.
Yeah.
I see along those lines, Carl wanted to know as well if you also deal with reverse mortgages. That's something you can assist with? Or?
No, we do, but I will say that I think there are better alternatives out there.
And actually, I just got off a call with 8 women across Ontario, like some of the biggest realtors in our province, talking about that exact same thing. So Carl, I'll also jump on a call with you later just to talk about some of the different options we're hearing.
Yeah,
Love to hear yours, Rakhee.
for sure. There are alternative options. It's not a product I've really supported to date. I think there are better options out there. However, at times it can be the right product. It's very specific to the client's individual circumstances. But I prefer to explore alternatives prior to the reverse mortgage option. I think there are better options available.
So really just like, when we as a team do our, our buyer and seller initial consultation to find out what their goals and needs and wants are to make sure we find the best house for them or the best sale price. It's the same thing with you and your team, right?
Yeah.
Okay, great.
We're thinking long term. Oftentimes when a product it's important to understand sort of all your options before selecting an alternative lending product. I find there is a market for the alternative lending products, and it can be an excellent fit depending on the client situation. But I do think that some of the conventional sort of options available are going to yield a lower rate, and sometimes put the clients in a better sort of overall financial position, which is our overall sort of priority, is always positioning the client in their best interests.
That's great.
Once we collect the information, we submit for financing, and then a pre-approval is secured. At that point, you're in a position to begin, whether it's proceeding with a refinance or a renewal, or, shopping for the right property. And we continue to be available to support as needed through the home search, available to run numbers on any properties of interest. And, we work very closely with our realtor partners to ensure that you're working within your affordability on a purchase as well. Thank you.
That was great. Thanks so much, Rakhee. It was
Sure.
really, really good. It covered a lot of information there. But I think, again, like we've said the whole time, is, have the initial conversation, right? Reach out to us, to you and your team, just to understand what options are moving forward.
Rakhee, I just have one other question myself for you on a personal note and professional note. How are you finding the appraisals coming in these days? Because I know we're seeing a lot more drive-bys. I know as realtors, we're getting a lot more calls. We're answering a lot more questions to the appraisers, but I don't mind that. I've always liked that part. Are you finding the banks are still pretty fair though in appraising at sales prices?
So we are finding that we're rescuing deals because appraisals at bank level are starting to fall short. Some of our, the appraisal companies that the banks use directly are basing, because we're right at that 90-day cusp right now of the onset of COVID. And the data in the last 90 days is not relevant, but there hasn't been an official sort of policy on how this is all going to transpire. Nothing has actually formally been communicated. So
Right.
what we are finding is this is where we have relationships with our appraisers. They do their additional sort of due diligence. I'm working very actively, depending on price point, we're working very closely with our realtors. If there isn't data to justify, then I'm securing that appraisal same day. We need to ensure we're protecting our clients, which again is why this whole pre-approval process is so critical, because if I have this down, I can move very quickly to ensure that I'm getting the appraisal done on the same day, so that, yes, if clients' financial covenants are strong, I still can't give you my blessing without mitigating that appraisal piece today. I don't know what's sold in the area. I don't know if there's going to be relevant data. And if I'm concerned, then I'm going to need to ensure that I'm working with an appraiser that's flexible and educated to the new way of doing business. We've always been very purchase heavy. That's kind of how my business has been based. So touch wood, to date, we've been successful in getting our appraisals to come through.
Yeah.
Where I've been nervous is outside of the city, in areas such as Alliston and just Innisfil, like just outside of the city. But even with those, we've been successful to date in getting those at value.
I know I've been watching the rural areas north of the city because a lot of our clients are talking about either getting secondary properties to one day retire to, or a lot of people thinking now maybe the time to leave the city. And the properties outside the city are still selling well. And maybe that is because we are seeing that initial group of people saying, well, maybe it is time to I was going to do it next year. I'm just going to do it now. I don't want to do a quarantine again in this house. I want my next one to be somewhere else.
That's an excellent conversation. So just to kind of like touch on that, it is important that if you have a client that is looking to move outside of the city and beyond that $1.2 million price point, anything above 1.2 is usually subject to sliding scale. And that is formal policy, and it has been in place with our banks for some time. But what we generally find is that in Ontario in general, we can generally get the exception to sliding scale. What I am finding is that lenders are being a little bit more conservative with that now. We had a property, Niagara on the Lake, beautiful rebuild, lenders did not have an appetite for the sliding scale. So again, we're seeing, and a year ago or 6 months ago, that would not have been a concern for me. So we're seeing a little bit of lenders wanting a little bit more sort of down payment and security above that $1.2 million price point outside of the city. And those that are looking to buy a secondary property, kind of like a vacation, or potentially, you know, I have clients myself that are renting their downtown condos and moving out to Muskoka and purchasing homes. These are actually zoned as single family residential. But in the eye of a lender, if it's a cottage property, if it's close to water, they're going to want that 35% down payment conventionally. Now, under CMHC and Genworth, they will do insured 10% up to a maximum mortgage. So you could do 10% down payment up to a maximum mortgage loan of 380, but they are being flexible with that now. So I have successfully taken it to 600,000 and 700,000 in the last couple of weeks. They are willing to give us that sort of added leeway if it's insured, meaning it's a safer investment for our mortgage lenders, or they're looking for that minimum of 35% if it's conventional. Now, if it does not have all season access or private road access, then you can expect that to go up to 50%.
Wow. Wow. I think the biggest lesson, guys, is be prepared. I mean, we've always said that, you know, our mantra is always, we provide enough information so you can make the best decisions for your family. But if the information is changing quickly, we can't assume that any approval you got last month or 2 months ago, or any conversation you had, don't assume it's all fine. And if you need that money in a couple of weeks, it's all going to be there. So I think we have to revisit that. And if you are looking for financing assistance here at the Mulholland Ross Group, we highly recommend Rakhee and her team of professionals. They're all excellent. I want to just remind everyone as well, every week we send out a sales report. We're including, I think it's about, I can't remember, 26 communities across the GTA. And we're giving you the actual sold listings from the previous week in that neighborhood so that you can see what's actually selling. So you can watch the areas you might be interested in moving to, the areas you're living in. Again, we're just trying to give you all the information you need so you can make the best decisions. So do request our sales report. You can shoot us a note. We'll make sure you get them. And tell your friends about our Thursday at 4 o'clock Real Talk Live. Again, if you have any questions through the week, you can send any one of us up here a note and we'll make sure we answer it for you immediately. But we'd love to hear your questions, because chances are if you have a question, someone else does too, and we'd love to answer it here. We have any other questions?
Just looking through the chats, I don't see any other questions. Of course, you can reach out to us. Our number is 416-230-8500 or email support@mulhollandross.com. And we've also put Rakhee's contact info in the chat there. And we look forward to seeing you guys in the neighborhood, that's for sure.
Signing out from the Mulholland Ross Group, and thank you very much, Rakhee.
Thanks, Sarah. We'll see you soon.
See ya.